Sunday, April 28th, 2024, Maneko 64, home of alternative economics and contrarian views. Today we're going to look at something that has puzzled a lot of people out there, even in the alternative YouTube space, economic space, and that's stagflation. Yes, the puzzle of stagflation. It was a puzzle for Keynesian economists in the 70s, and I think it's going to be a puzzle for people again in the 2020s, not necessarily Keynesians. I'm going to try to show you why, despite the fact that the Fed has raised rates from like near zero back in 2022 to above 5%, and despite the fact that they've kept rates at these levels for a while now, I'm going to show you why I think they haven't done enough, and why we do have stagflation, and why, despite the fact that M1 and M2 have come off the most since the Great Depression, we still have stagflation. And it's very simple. But before we look at some charts, and we're going to look at charts to see why we still have stagflation, just want to thank all of you for your kind messages about wishing me a speedy recovery after my surgery. So I'd like to let you know what's going on in terms of that. It's improving every day. The only thing I have right now is still it's a little bit sore here. I have a scar here. It wasn't open heart surgery, thankfully. It was just a keyhole, but it's still really sore. I have to send photos of the scar to the hospital regularly and tell them on a scale of 1 to 10 how much it hurts. And about a week ago, I was saying it's like 4 to 5 out of 10, but now it's down to around 1 or 2, so it's getting a lot better. I'm going out regularly, just once a day, taking Rudy out. We went out this morning. It's cold and miserable still here in the UK. I think it's been, I don't remember the last time April's been so cold and miserable as this year. I'm sure the powers that be and the mainstream press are going to come out and say, oh, April's been the warmest month on record. That's the kind of thing they do with this climate agenda. But anyway, I'm much better. I'm still not going to be doing my live stream tonight. That's going to have to wait. And another thing I wanted to let you guys know before we look at stagflation and the monetary aggregates of M1 and M2 is a little bit about the situation as far as bullion and my affiliates are concerned. Miles Franklin, they have a few specials. For example, they've got pre-1965 dimes and quarters for only $2.75 over spot. They've got random year 1 ounce silver Canadian maple leaves, only $3.25 over spot. And they've got pre-1933 Eagles, or $10 coins, gold coins, only 34 over spot. So if you're looking to add to your stack, if you're looking to start stacking, and you want to find out more about it, you can contact Miles Franklin by email, info@milesfranklin.com, or you can call them on 1-800-822-8080. And yeah, make sure you mention Mario or Maneko 64 sent you. And here in the UK, for my viewers, you can always check out Gold Investments. All the details for Gold Investments are below in the description of this video, and also for Miles Franklin, of course. And yeah, Gold Investments, they have some specials on as well for the UK viewers. Back to stagflation. Yeah, back in the 70s, a lot of the economists thought that it was impossible to have a slowdown or a recession in the economy and rising prices, which of course is the consequence of inflation. And that's really important as well, the true definition of inflation, as many of you know, because you've been watching me and I've been harping on about this for years. The true definition of inflation is not the CPI or the PCE. It's the rise in the supply of currency. That's all it is. Out of thin air, of course, in the fiat currency system, not backed by any hard assets like gold and silver. That's basically what inflation is. And it results usually in the rise in the prices of general goods and services. And you might have a period of inflation, i.e. the rise in the supply of currency. And at the same time, you might have some prices that are actually dropping, but generally they rise. We've been brainwashed, well, at least most people have been brainwashed, and I was up until maybe 20, 30 years ago, to think that the CPI is inflation. So, and why is that? Well, because the Fed and the government, they can tinker and kind of twist the basket that they use for CPI. There's an old saying, I think it was Benjamin Disraeli, British Prime Minister in the 19th century, who said something to the effect of there are lies, damn lies, and then there are statistics. So with the CPI, they can always tinker with it, but with the supply of currency, it's very hard to lie about it because it's out there, and you can't really change things that easily like you can with the CPI. And that's why they've changed the definition of inflation. They don't look at the monetary aggregates anymore to give an indication of inflation. They've convinced even the most sophisticated investors and economists that the CPI is inflation, which is totally backwards because CPI is the consequence of inflation. So I like to put that out there first. And even in the alternative, a lot of people know that. But they're also puzzled because M1 and M2 have come off, and these are currency aggregates. They call them monetary aggregates, but I would argue that they're really currency aggregates. They're arguing, yes, they've come off a lot since the high around April 2022. That's when these aggregates topped M1 and M2. And it was, not surprisingly, in March of 2022 that the Fed started raising rates from 0. And they raised rates all the way to, like, I think it's 5.25 now. I'm not sure the exact target, 5.25 to 5.5. By sometime last year, I think in the summer last year, they've kept it at that level. And despite that, we're seeing what people call inflation, which is really confusing. CPI and also PCE, which is personal consumption expenditures, which is the Fed's preferred measure of inflation. We're seeing that starting to pick up again, instead of going towards 2%, which for the Fed is a magical number, even though it means that the prices are still rising by 2%, which I don't understand why that is a good thing. It's just another 2% tax on the consumer, right? So, and we've seen the latest GDP numbers. They were a lot lower than expected. I think they came out at 1.6, and it's the advanced number. They will revise that another 2 times. It might even be revised lower. And I saw a video on YouTube earlier today, and it was on the Hugh Hendry YouTube channel with George Gammon. And they were talking about the yen carry trade, and then they were talking about stagflation and GDP. And George Gammon said he didn't understand why we have stagflation, even though M1 and M2 have come off quite a bit. And Hugh Hendry, he brought up this idea that there's still dollars being created offshore, but I don't think that's the reason why, and I'm going to show you right now. So before I show you the charts, just want to let you know what M1 is. M1 is a narrow measure of money supply or currency supply. Why do I say that? Well, because we don't have real money, gold and silver anymore. We have empty promissory notes or Federal Reserve notes or Bank of England notes. But be as it may, M1 is a narrow measure of the money supply that includes currency, demand deposits. Well, demand deposits are like your checking accounts, and the other liquid deposits, including savings deposits. So I think it also includes traveler's checks and coins. But who uses traveler's checks these days? I haven't used traveler's checks in decades. I remember them well, though. When we used to travel in the 70s, my dad used to carry the American Express traveler's checks. What about M2? Well, M2 is M1 plus some other more long-term savings and certificate of deposits up to a certain amount. That's all M2 is. Some people argue that you should include short-term treasury bills into M2, but it's not included there. So M2 could be even higher. So now that we've got that out of the way, we're going to look at some charts, and the reason why I think the Fed hasn't done enough really to rein in the real inflation, i.e. the rise and the amount of currency as per M1 and M2 in the system, and that's why we're still seeing prices rise. And when prices rise and things get more expensive, the cost of doing business gets more expensive, it permeates through the economy. It leads to businesses raising their prices. It leads to businesses streamlining by getting rid of employees. They try to automate, they try to cut back, and the economy shrinks. And then, and that's why you have like a stagflationary environment. So I'm starting here with M1, and I'm going to show you M1 since it topped in around April of 2022, which makes sense because the Fed started raising rates in March of 2022. And yes, they've cut it back quite a bit. Looking just at this, I can see why some people are confused, why we're having stagflation, especially due to the fact that we haven't seen this cut in M1 since the Great Depression. But as you can see here as well, it looks like this process of decreasing M1 is starting to bottom. I've drawn a trend line here, a red trend line, and it looks like it's starting to pick up a little bit. Yes, and it was almost at, well, above 20.4 trillion, and now is at around 18 trillion. So yes, it has come off over 2 trillion. But so we're going to move forward here to the next chart. And this is the chart that is really important. And that's why I think it's so important to look at charts, especially the longer term trend, because if you just look at M2 in the last 2 years or so, you'd say, oh, we're in a major deflationary environment. But if you look at this chart going all the way back to, I think, it's 1990, you're going to see a huge jump off the charts. Well, if the St. Louis Fed, which publishes these data, hadn't enlarged the chart, it would have been off the charts. And this was all to do with what happened in 2020 and COVID, right? We jumped massively from, from around 4 trillion all the way up to almost 21 trillion by April of 2022. And yes, you can see now the bigger picture that we've come off. Looks like it's bottoming. And I drew another red line here. And that is the old trend prior to 2020. If we hadn't had the events of 2020, this is pretty much where M1 would have been by now. It would have been around 6 trillion. But it's still around 18 trillion. And therein lies the reason why we have stagflation. Yes, we've seen a big drop in M1, but it's still way above trend. And all that currency, as per M1, that's been created in the system, it's still in circulation. So what is this telling me? Well, it's telling me that the Fed hasn't done enough. They haven't done enough to bring the currency or money supply back to trend. And why are prices rising then? Well, because there's still too much currency chasing not enough goods and services in the economy. And you can add government spending to that. Government doesn't produce anything, and government is spending a lot, and that makes it even worse. So do you really think the Fed is going to raise rates enough to bring this M1 back down to trend? Well, there's the old saying that hell will freeze over before that happens. And I think that's why gold and silver are starting to perk up. And that's why I think commodities are starting to perk up. And that's why I think the non-Western countries are loading up on gold and silver, because they can see the writing on the wall. The dollar is going to continue to devalue massively. So let's look at M2, because why not? So I've got the chart here of M2, and it looks like it's bottoming as well. Yes, it's been cut quite a bit from just around 21.7 trillion back in April of 2022. And we're back to around 20.8 trillion. So it actually hasn't gone down that much. It's gone down about 1 trillion. Not as much as M1, excuse me. So there's the bottoming process. I've drawn a trend line there as well. It looks like we're breaking out of it. And then I wanted to show you this one. And this is M2 all the way back to 1959. And you can see that this has been a long-term process. It's not just since 2020 that the authorities have been inflating and accelerating the inflation. The red line there is a trend that would have continued in the mid-90s if the Fed hadn't accommodated as much under the Greenspan era as it did. And you can see that right now, you know, if we went back to that trend line, it would be around 8 trillion. And then there's the acceleration in M2 after the '08 crisis. And if we hadn't accelerated then, you can see that we'd be probably around 14, 15 trillion right now. Of course, we're not there. We're at almost 21 trillion. And then there's the acceleration of 2020. We went off another kind of trend line there that had accelerated since '08. And yes, it's come back towards that line, but just notice how it's just been accelerating ever since the mid-90s. So I thought I'd give you a longer term picture here. I've got another chart here. It's more condensed, and it's not up until recently, but it just goes to show you how the Fed under Greenspan and Bernanke and the rest have been accelerating M2, and you can clearly see here how the rate of the trends have been going up and up. So that's why I think we're going to continue to see, unfortunately, a slowdown in the economy or a stagnation in the economy. I'm sure all the fiscal spending, all the war spending is one of the reasons why the economy hasn't gone down more or hasn't been in a recession more. The private sector, unfortunately, is going to continue to get hurt. Why? Well, because of higher prices, because the inflation of the currency hasn't been reined in. And unfortunately, in a fiat currency debt-based system, if you destroy the debt, you have to destroy the debt to destroy the currency, to bring the inflation down, to bring prices down. You do that, you destroy the economy as well. So, yeah, it's a position I wouldn't want to be in. Well, of course, I'm not the Fed chairman. But yes, not just the Fed, but all major Western central banks are between a rock and a hard place. And it's unfortunate that you don't hear anything about them buying gold like the other central banks, which is a shame, which makes me believe that this is going to continue. And of course, they're going to keep telling us that they're combating inflation, but what they're doing is tinkering more and more with the PCE, with the CPI, and they're going to also maybe just raise their target from 2% maybe to 3 and 4. It will be the, it will be, the excuse will be that it's better to have a little more inflation than to have a collapse of the system. And that's the excuse they're going to give you, especially in 2024, where we have so many elections in the West. So there you go. With that, I'd like to wish you all a very good day and a very good rest of the weekend. Take care. Bye.